Welcome back. We are live. I'm Dan Beer, and we're going to hit the San Diego County State of the Market, the October version. So here we are. I'm just going to get everything set up for us. We're going to take off. In the meantime, as everybody comes in, it's just a good opportunity for me to make sure that the audio is working, that the video is working. So if you can go to the chat, it's just always helpful. There's more just mishaps with this than there really ever should be. So if you were to just type in the chat, let me know, yes, I can hear you. Yes, I can see you. Any of that, all of it is very, very helpful. And we will kick off. In the meantime, assuming you can hear me and see me, I still don't see the chat coming through. So let me, there we go. So we can hear. All right, good. Looks like that's all good. Thank you, Mary. Thank you, Nicholas, William. Appreciate you guys. All right. So just a very quick reminder of what we're doing here. I've been doing this now monthly for the last several months. And as the market's changing and we're all trying to make sense of it, and there's just so much confusion, right, around what's happening. Headlines are built to scare us. So my intent is, this is that place that, it's nothing like the news that's built to be one way or built to be another way, but not just give you the facts. I am here to interpret the facts, give you the facts most importantly, but help you make sense of them, help put context behind them, and also essentially just be the lighthouse for where are we headed, what's happening, how to interpret the data. We'll talk about, for example, today, core inflation versus headline inflation, and that all gets weaved into the news headlines. Well, what does it all mean? That's just one example. So let's jump in. I'll give you the agenda. And as always, my promise is let's get out of here in no more than 25, 30 minutes, absolute tops, where you have a very thorough walkthrough of what the marketplace is doing. Quickly, if this is our first time meeting, give you a really brief introduction. I run Beer Home Team at eXp Realty. We've done over $2.4 billion worth of San Diego real estate sales here in the last 17 years, landing us on the Wall Street Journal list of top 50 teams in the country across all brands, Inc. 5000 four-time recipient, San Diego Business Journal best place to work, San Diego Business Journal top producing team in San Diego County, and expert guests on NBC, ABC, Fox Local News, etc. I only share in that, yes, I've been here around for a long time, seen about just about everything, been through multiple market changes, and I think I have the I have the ability to just cut through all the noise, give you what you really need to know today. This is my family, by the way, so I always just like to share them. At the end of the day, some people just know me from the billboards or different things around town, but this is the real me. This is what I get up for every day. So let's jump in. Here's the agenda that we're going to go over today. And we are going to, hold on a quick moment, having a quick little tech issue. All right, we're good. So we're going to go over the local market overview, make sure that we cross all through that. I mean, you're going to get really, really strong understanding of exactly where are we right now. Mortgage rates. With mortgage rates, you can understand where are we now versus where we've come from. What does it mean in terms of payments? So we're going to get a window into affordability, and so that's all answered for you. Inflation, we're going to, of course, as we always do, take a look at inflation. This time, however, we're going to take not just a look at inflation, but we're going to differentiate between core inflation and headline inflation, how those two are working right now, which one's rising, which one's dropping, and what it all means. Interest rate predictions. We'll make those, but we won't make them based on our own prediction or my prediction. I'm actually going to show you the data behind how Wall Street is betting right now, so you understand why the stock market moves that we're seeing happen, and also why did the positive jobs report that just came out, why did that actually create a very negative stock market move? All that tied back to inflation, so we'll cross that. We will go over mortgage rates, and so I have that there twice. Ignore. We have mortgage rates up above. And then finally, we'll talk about the reality of today's selling environment. Today's selling environment, what does it mean that when we see people chasing the market, which we're now starting to see? We'll also talk about rate buy downs. So with that, let's jump in. I do very quickly just want to mention that if this is your first time with us, we're doing this every month, but you're watching live. Some people, if you're watching us, also this is going to be on YouTube. And if you're watching on YouTube and this is your first time to the channel, make sure you hit the subscribe button, hit the bell for notifications. On this channel, we cross over everything that's living, breathing, eating, sleeping, the good, the bad, the ugly, absolutely everything you need to know San Diego County so that we can help you make a smooth move. And every single day we get messages from people just like you looking to make that move, and we absolutely love it. So we don't care if you're making your move in 9 days, 9 months, 9 years. All of it is the same to us. We just want to help make everything smooth for you on your transition. All right, so back to us live here in the presentation. Let's jump in. So moving forward, here's the total market overview. The total market overview, meaning not just condos, not just single family homes, but this is a blend of all properties across the marketplace, single family and attached homes. We'll see that new listings right now. And what we're looking at, let's just make sure we understand this. We're looking at September numbers because September is now complete. We're here at the beginning of October. So we have all the September data. Well, September new listings were down 23.8% versus a year ago. Now, that is less shortage of new listings versus what we saw in the August numbers. So we are, I guess, starting to see, relative to the previous month's drop, it's starting to improve. But still, there's just less coming on than there was at the same time a year ago. You're seeing it all reflected in the pending sales and the closed sales. So just actually, and this has been pretty consistent, we've been in the 33% range in terms of less transactions across the county. Well, we're in the 38% range now. So there's just less activity. And right now it's being all created by two different things. One is, yes, less homes coming to the market, but even with those less homes coming to the market, the absorption rate is worsening, meaning less homes are being actually absorbed, going under contract and finally going closed. So it's something to continue to watch, but there's no question about it. If you're selling your home in this environment, just something to know is there's a lot less actually going to contract than there was a year ago. Median sales price versus a year ago, however, is still higher. It's at 7.6% more than a year ago. $812,000 is our current median, was the median for September. And then average sales price was $1,008,000 compared to a year prior was 3.8% less, right? So it was $972,000 a year prior. Just before we even go on any further, I do want you to just notice on the right side of this, you're getting the year-to-date comparison, 2021 versus 2022, while on the left side of this chart is the September comparison. And you're going to note, for example, let's just jump back up to the top. Pending sales and closed sales. For the month, 38% and 37% drops, but for the year, only 25 and 23%. Why? Well, the reason for that is we had excellent January, February, March, April, right before all the interest rate changes started and before all of these numbers started to shift. And so that's why the year numbers are better than the current month numbers, though the current month numbers have been pretty consistently in this zone over the course of the last 3 or so months. And so we could predict pretty well that those year-to-date numbers are going to continue to worsen as we move further into the end of this year, as we've just here started the fourth quarter. I do want to take your attention over to days on market. Days on market have jumped from 21 days on market September of 2021 up to 31 days on market September 2022. You can look at that as, hey, it's just 10 days. You could also look at that as, hey, that's a 47.6% bump. That is huge. A 47.6% bump in interest rates. That is a big deal right there. By the way, as I go through this, if you're with us live, feel free to jump into the chat, ask any questions. We'd be very happy to, I'll make sure I always do, whether I answer them in this presentation or I take the time to do so afterwards. I will answer 100% of the questions. Moving forward here, as those days on market are rising, you can see how that starts to chip away at the sales price acceleration. Okay, so that's why we're just starting to see those changes. Homes for sale. Let's talk about homes for sale and inventory. 4,312 homes for sale versus a year ago, there would have been only 3,300. So here's some good news. If you're a buyer, you have more choice. And remember something, you do marry the home, you date the rate. Now, you don't marry the home and that you have to be in it the rest of your life, like the way we think about marriage, but for the most part, the home is long-term, the rate is short-term. And because rates are the thing really behind that, there is opportunity right now for people that understand that that you have the ability to use the increased inventory. I mean, look at the final column, 70% more inventory than a year ago, the same month. So with that, you have 70% more choice in what you're going to. Their homes are sticking around longer, 70% more homes to choose from, and that tells you that you have opportunity as a buyer. And we'll talk about that a little bit more as we go forward here. So that's the reality of the marketplace. And I see, for example, someone saying, "Hey, we have our home for sale," and I'm concerned. Well, the biggest thing I have is I need to be able to deliver the truth of what's in front of us, what the market's doing, and then there's going to be strategy around every bit of it. If we understand what the market's doing, we can get out in front of it. And we're going to talk today about what it means to chase the market. And I'll illustrate that for you so that you're not caught in that space, okay? So let's jump forward here. Let's take a quick look at inflation. Inflation is really continues to be the key player in the story. And I'm not sure if it's the antagonist or the protagonist, probably the antagonist, but this is the primary character, no question about it, is in what's happening with inflation. Now, right now in the headlines, we're starting to see more about headline inflation versus core inflation, though it's very seldom actually explained what that means. So my intention here is I want you to understand exactly what that is so that when you're reading headlines and hearing the news, you know exactly how to interpret it. Headline inflation is a measure of the total inflation within the economy, okay, including commodities such as food and energy, oil, and gas. So in other words, it's goods plus services equals headline inflation. Looking at core inflation, and we'll contrast the two here in a moment, looking at core inflation, that's all items minus or less food and energy. And what's interesting to note right now is headline inflation. What we predict on Thursday when the new inflation numbers come out, the predictions out there right now, headline inflation rising, core inflation dropping. So what that means is that when you look at all items, all goods and services, but you subtract out food and energy, they actually believe that core inflation is dropping finally, which means really just that food and energy prices are starting to drop. Now, those are also typically the most volatile components that make up what we measure in terms of inflation. So that is predicted to be dropping. But when you look at headline inflation, which is all goods and services, okay, all goods and services. Or actually, hold on, give me a quick second. Right, no, excuse me. I said that to you backwards. Core inflation, food and energy. When you subtract out food and energy, those are dropping. So then core inflation rising. Headline inflation, when you add those back in, that looks to be dropping. But anyway, I wanted you to just differentiate between what headline inflation is and core inflation, because when we're seeing inflation numbers being reported, you do have to understand, does this include food and energy or does it not? Because this is really one of those things that's easy to manipulate if you're just not reporting if you're not asking the question right underneath the question, just understanding what are they reporting on, or are they just using whatever headline is convenient for them. Now, moving here forward, there's a lot of questions around, well, why did the positive jobs report just last week, why did the positive jobs report actually impact the stock market in such a negative way? So as you remember, about a week ago, the stock market had 2 stellar days. I mean, they were beautiful. It was a huge gain. And we had a huge gain in the stock market. And then all of a sudden on Wednesday, the job market report comes out. The job report comes out and it is stellar. In fact, here's what it was. It said 263,000 jobs were created in September. Okay. So, all right. Someone's suggesting I move my little box up here. Why not? Thanks for the suggestion. Hopefully that's better. Thank you for that. Definitely want this to be good for you guys. So why, when 263 new jobs are created, why, when unemployment rate drops to 3.5% from 3.7%, which you would think would be a beautiful, wonderful thing, does the stock market just implode as soon as that happens? And today it dropped again. Well, why does that happen? The reason why is that what that does is that really strong jobs report actually signals demand. It signals that there's a ton of demand. And so there's so much demand that people have to add jobs, or businesses have to add jobs. And all of that demand also signals upward pressure in pricing, which signals inflation. And so at the end of the day, inflation continues to be the story that makes up all news, really, as driving everything, because it's just this wacky world we live in where as long as we have an extremely strong job market to this degree, we are going to continue to see the Fed say, okay, hold on a second. If we have that much demand, then there's going to be upward pricing pressure, which means we have to raise the federal funds rate, raise interest rates. That's what you hear about, to combat inflation. And what does Wall Street hate? It hates higher interest rates. And by the way, so does the real estate market. Not that interest rates that the Fed moves, that's the federal funds rate, that's the rate at which banks borrow, but it all influences the entire system. And so when we believe that the Fed will be raising rates, the stock market doesn't love it, the mortgage markets don't love it, it all is tied together. So it's just this interesting, weird world where really, until we start hitting 5-6% unemployment, okay, just you have to understand that, and it sounds crazy. But the government wants us to have more unemployment than what we have right now, because not until then will they say, okay, we've done our job of taming inflation. We can stop raising the Fed funds rate, which is still predicted to go up about another 1.5 points, and you'll see that in a moment. So that, I hope that made sense to you. That's why the jobs report is such a big impact and typically has the opposite effect, right? Somebody, you could be watching and saying, awesome, great jobs report. The economy is doing wonderfully. Stock market gets slammed. Well, that's the reason why. It signals demand, which signals upward pricing pressure, which equals inflation. And that equals higher interest rates from the Fed, which is bad for business. It's basically the reason they're raising the rates is to try to kill demand, to have less. And one of the things that will signal to them that we're killing demand is, hey, we have less jobs. Unemployment rate is reaching 5-6%. That's what they're looking for. So what will the Fed do next? Right now, and you'll see at the top here, the current target rate is 300 to 325 basis points. You could just, basis points, it's just a different way of saying 3% to 3.25%. So it's referred to as basis points, 300 to 325. Right now, the next time that the Fed meets and is going to address interest rates will be on the 2nd of November. Okay, so on November 2nd, and Mary, if you're watching this and you don't mind walking me in the water, that would be wonderful. But thank you. So on the 2nd of November, right now, Wall Street is predicting that the Fed will raise rates another 0.75 of a point. And you see that here where the predicted is that the Wall Street, what it's betting on, it's saying there's a 78.4 chance that they're going to raise the rate all the way to 375 to 400. And only a 21.6% chance it's going to go to 350 to 375, okay, which would be a 0.5 point hike. That's in November. Now, keep in mind, if it went all the way to 375 to 400, the next meeting, Wall Street is making a bet that there's a 57.9% chance that it would then go to 425 to 450. And if it goes to 425 to 450, compared to the previous month, 475 to 400, which is the bet, that means they think it'll then do another 0.5 point from that point at the December meeting, with a little bit of a chance of only a 0.25 point and a little bit of a chance of a 0.75 point hike, but no chance that there won't be a second hike. So they believe absolutely no matter what, there will be at least 2 more hikes. And then if you go to the following meeting, which will not be until February, there is no January meeting. The February meeting, see, they're predicting that it goes from 425 to 450 to 450 to 475. So only a 0.25 point and then finally stay put. So in other words, the market believes and is pricing in right now that there's about 1.5 more points. Okay, so 1.5% or another 150 basis points, however you want to state it, increases over what we're at now. So it'll be interesting to watch. And now you'll get these market swings based on, is the job report high? Is the jobs report low? How are we doing around the core inflation numbers. And so basically watching the jobs market, watching the inflation reports, which comes out Thursday, by the way, definitely tune into that. That's going to signal to you, are we finally at the end of the cycle, or do we have a lot more to go? But that is what the market is currently pricing in. Now, I want to mention this quickly before we move on. If what's being priced in is exactly what happens, theoretically, we shouldn't see any more erosion in even mortgage rates because the banks are already pricing this in. The stock market shouldn't react poorly because they're pricing this in. It's when the expectations change. And you'll see here, it's a pretty split opinion for the February meeting. December meeting, pretty split opinion. The November meeting, there's, I don't want to say it's consensus, but there's a very strong bet that it's at least 3/4 of a point. All right, moving here forward. That's the Fed funds rate versus mortgage rates, which I think I already explained there. So what we're looking at again, that's the Fed funds rate. When you hear that the Fed's raising rates, they're raising the rate at which they allow banks to borrow at from the Federal Reserve. Mortgage rates are different. Mortgage rates are what we as borrowers, right, we take our mortgages out at and what we have to pay the banks. Of course, the two are interconnected and influenced by one another. But the mortgage markets, they're looking out ahead. What do we think it's going to be? And that's why I share those Wall Street reports with you, because it tells us if we believe that mortgage rates are going to continue to rise or if they're going to stay put. So let's look at rates. Where are mortgage rates specifically right now? Well, the 30-year fixed monthly mortgage payment. And we look at this every month when we do this. So we'll just keep updating you on how this moves. 30-year fixed mortgage monthly mortgage payment for a $900,000 home with 20% down would be a $720,000 loan. When rates were at 3% before this big move happened, that payment would have been $3,035. Today, now that rates are at 6.375, so more than twice the rate, no points, the monthly mortgage payment would be $4,491. So it would be about another $1,400 a month for the same house. By most American standards, that's just too much for families to handle. So what that means is that starts to affect pricing. Now, think about what price ranges can handle that more than others. So, if you're in the median price range, that's a big deal. Now, if you're a $3 or $4 million property, maybe that's not as big a deal. It's just, hey, it's kind of inconvenient. We've got to pay another $4 or $5 grand. But as crazy as it sounds, that may not mean as much to them. So you do have to just be cognizant of what ends of the market is this most affecting, and definitely that's where I have concern. Just note also that 6.375% rate with no points, that is through the lender that we most trust and tend to lean on. The market rates right now are mostly at 6.5%, and you have to pay 1 or 2 points, which would mean on this loan you'd be paying $7,000 to $14,000 to have that 6.5% rate. But through the right introductions, you could also be a little bit of a lower rate, no points, so you would avoid that. So just something to know about, and feel free to reach out if you need an introduction. I don't have a slide for this, but it's just a good point also for me to talk about is, I think, a lot of people are asking, well, what's going on with the market? And when I look at really what do I think could start to hurt the marketplace, I think about the people that took out HELOCs, home equity lines of credit. If you took a home equity line of credit out on your property when things were really, really good, then think about, I'll come back to the slideshow, but I want to make sure that I share this. I think about people that, rates were so low, all of a sudden so much equity in your property. There were people that all of a sudden had $500,000 of equity they never had counted on. And they had the ability to pull some of that out of their home through a HELOC at a really low rate, 2.5%, 3%, and finance lifestyle, whether that was financing a vacation or financing a boat, hopefully not, or just financing lifestyle. Could have even been something really well-intended, like private schools, anything. And when they did the math on it at that previously really low rate, let's say it was $200 a month extra that they would have to pay to be able to have that lifestyle with this thing that they spent the money on. And they were good. Hey, I can afford the $200 a month. Great. But now remember that HELOCs, for the most part, everyone I've ever seen have floating rates. They're not fixed. And so they move with the market. And all of a sudden, when that payment isn't $200 a month, if it's now $400 a month, or when you look at, if they had taken out more, what if it had been a $500 a month that they felt good about? But what if it's now $1,000 a month? And most HELOCs are interest only. So they'll just tend to literally double the payment. Well, that's a big deal. All of a sudden it's, hey, I was able to afford the $300 a month from, I was paying a year ago, but gosh, $600 a month. I can't make these payments anymore and I'm in trouble. And I think that's where we're going to start to see a lot of inventory from also is HELOC borrowers financing lifestyle that were able to make that payment at the old interest rates, but can't anymore. I'm looking for a lot more of that to happen. Not that I want it to happen, but it's just something that I think is definitely going to be there. Somebody's asking, do HELOCs usually have prepayment penalties? The answer is no. I don't know that I've ever seen a HELOC with a prepayment penalty. So all of the ones I've seen do not have one. So it would not be normal for them to. So just something for us to be mindful of and watching. All right, back over here. The reality of today's selling market. Right, the selling environment right now. One is we're watching people chase the market. And I can just tell you this unequivocally, we are seeing, I'm going to try something that I've never done. So I'm going to try to turn on my whiteboard function and see if this is a complete disaster. And if it is, I'll just come back. But basically, we talk about chasing the market. And let me describe what this is. What does it mean when you're chasing the market? Basically, you start getting, I think this is going to work out pretty well. You start, about a month, or excuse me, say 3, 4, 5 months ago, there was nothing on the market. I mean, literally, if your home was on the market in your neighborhood, you were the only one. It was just you versus nobody. But today what's happening is you're starting to get these little things, I'm going to call them houses, and those are roofs, believe it or not, even though they look like cupcakes or mushrooms, or I'm not sure what they look like, but they're houses, just trust me. So this represents a bunch of homes that now start coming to market and sort of accumulating at a certain price point. Similar type of home, similar neighborhood, or in the same neighborhood, I should say, similar price point. And the reason that they start accumulating there is they say, well, what was the last sale? We're so conditioned to this, let's look to the past and what was the last sale philosophy. Well, what happens now is everyone starts pricing the same. And because there's not any clear differentiation between any one home demonstrating, hey, I'm absolutely offering the buyer value versus my competition, they just sort of bunch up. You might notice around your neighborhood that while there were no homes for sale 4 months ago, there might be 2, 3, 4, 5 homes for sale now. So that's what you're seeing. Well, what happens is this ends up being this space where nothing's happening. Except for, see this house right here? This guy, something goes on in their life and they say, you know what, I have to get to Tennessee where I'm planning on moving. I just have to go. I can't wait any longer. Something's happening with whatever. My mom is sick. I've got to go there. I've got to take care of her. I can't stand around anymore. Sorry, guys. I'm dropping my price. I'm going to reprice right here. And what happens is they sell. They sell. And so these guys all start to join. They say, oh, I guess that's where the market is. The new comp, and that's what they'll say, the comps, right? The new comp is here. So all these other homes will kind of start to come over and join the party, right? Well, guess what happens? Now that's where everyone's bunched up. Maybe you get a brand new listing that comes on the market, joins the party as well, and everyone sits around, everyone's sitting, no one sells. We've seen this in every market. And remember, I started this in 2005, so I sat through 2006, 7, 8, 9, 10, 11. Tough times. And I'm not suggesting that happens, but the function of what it means to chase the market, this is what it looks like. Because then everyone says, oh, well, if that was the last sale, let me price it there. And what happens is this person eventually, for whatever personal reason they have, they drop down to here, they sell, and then everyone else chases. And they price where that one sold. And that's really the moral of the story, essentially, is if you keep pricing to the last sale in a market that has growing inventory, as we saw when we looked at the market conditions, if you are pricing to the last sale in a market where there's growing days on market, And by the way, this is a really good time for me to pause and say, listen, if you're on the market, this is not a, like, I can't give you advice. If you're on the market right now, go turn around, talk to your agent, and like they have to give you the advice. But in terms of general, just speaking in generalities, this now becomes a new market. And this pattern repeats itself, right? So eventually there's a new market here and there's a new market here. And eventually that's just the pattern that happens. So professional home sellers, people that are, been there and done it through multiple markets. What's a professional home seller? What's someone that's been successful, actually really made money during different markets? Because remember, it's never the market that beats up a buyer or a seller. It's the lack of information, data, and agenda-driven salespeople that push something and that just don't, most importantly, have the data to just share why you should always see what looked like here. It looked like, hey, that guy's kind of crazy. He dropped this price to there. Well, it turned out he wasn't crazy. He sold for more than all of these people here and all of these people here and all these people here. He said you have to be in front of the market. There is no way to win in a market like this if you are not willing to be just ahead of it. If you go to the market, you do not exist. You have to be right ahead of it. Of course, there's science and art to how far ahead, and that becomes a more personalized conversation to your property type, your neighborhood, your price point, all of it. But this concept, the people that understood this versus the people that didn't during the Great Recession, are literally the people that survived versus those that didn't. I mean, it's such a simple concept that makes too much sense, but too many people ignore it because it feels so negative to be ahead of the market in a declining environment. But that is ultimately what looks like. It's that short-term pain for a much longer-term gain. You get the capital back, you get to reallocate it where you need it, where you want it, where it's going to give you return, where you find opportunity. So that is something that, again, if you want to talk about that concept more, like I'm passionate about this. I teach this to realtors all over the country. I just had 60 realtors in my office today that came to learn. And this is a very simple, but it's too important. We're now seeing people chasing, and they chase. That's why they go out reduction after reduction after reduction after reduction while never really getting anywhere. That is not the game. Just, you have to make the right move as early as possible, be as high up in this ladder as you can be. So we're seeing that. That's part of the market conditions that we're seeing right now. And we're also, just on the strategy side, it's interesting. We're seeing something we haven't seen for years, which are rate buy downs. And so I would encourage you to turn around, talk to your agent about this. But rate buy downs, this is where, let's say you have $1 million property. You could choose to reduce the price, but you could also choose to entice the buyer with a rate buy down that actually might be worth a lot more to them, because it's not that the buyer didn't want to pay you $1 million, it's that they now can't because the rate's going to be 6.5% or 7%, and they need it to be something less. So you'll hear terms. I just want to interpret these things so you're smart about it when you hear them. Let's talk about people when you hear the term, for example, a 2-1 rate buy down. Well, what that means is, let's imagine that buying the rate, it means that in year one of your loan, instead of paying 6.5%, the seller puts aside in an account that just lives. It's an account that lives in its own space for you, and it pays down that mortgage payment every single month over the course of the first year, so that you essentially have the equivalent of, instead of paying a 6.5% rate, you're paying a 4.5% rate. So you have a 2-point under market rate for the first year. Now, what might that have cost the seller? Maybe it cost the seller $18,000 if they had to move into this account to make this happen for you. But the seller was probably maybe willing to, maybe that's better even for the seller. So this is a win-win scenario where the seller, maybe they were thinking about doing a $25,000 price reduction. Instead, they can move $18,000 into this account, and you as the buyer say, listen, I don't need a $25,000 price reduction as much as I need to not pay a 6.5% rate. And if you give me this 2-1 buy down, I believe that over the course of the next 2 years, I'll be able to refinance into a permanent rate at a lower, that'll be lower. So year one, let me slow down here. Year one, your payment would be, or your payment would be the equivalent of, instead of a 6.5% rate, 4.5% rate. And in year 2 of the loan, using this money that the seller deposits into this account, the payment gets paid down every month so that you are making the equivalent of a 5.5% payment. So year 1, it's 2 points less. Year 2, it's 1 point less. That's how the 2-1 buy down works. And it's just an interesting strategy for sellers to use right now so that they have an ultimately higher net, and that the buyer actually says, hey, I'm awesome with that. I'm happy with you having a higher net because I'm going to have the payment I want. It gets me through 2 years in which I'm going to find a refinance window. And in that refinance window, I'm going to get myself into a permanent loan and all will be great, right? So there's a lot of, that is actually a full explanation of what it is, but I do know that it takes sometimes a moment to truly understand it. If you're this will be on YouTube, you can go watch the replay, but of course you could drop me a comment, whether you're on YouTube, drop a comment, whether you're here, drop a comment, whether you're receiving this later via email me back, just reach out if you need to go through that. But again, it's how can we find ways right now through creative financing, through creative marketing, through creative terms to give both parties what they're looking for, and ultimately not just have to live in this like, hey, I guess rates are higher and life isn't so good environment, which most people just succumb themselves to. But it can be done in a different way. It just takes different thinking, and it takes an understanding of all the tools that are in front of you. So my intention here is always just on these and these market updates is you're going to hear things, read headlines, etc. You're going to hear about things like the 2-1 rate buy downs. Well, what does it mean? Now you know. With that, if you have any other real estate questions, you can email them to info@beerhometeam.com. info@beerhometeam.com. I do answer 100% of the questions, and I answer them personally. If you're here on YouTube, you could of course drop it into the comments. I'll answer them there as well. And don't forget to hit that subscribe button and that bell for notifications. Guys, I appreciate you. I appreciate you tuning in as always. And anything that I can do to answer any further questions, please make sure that you let me know. Tom, I see that you want to talk about what areas you recommend rental investment in. And it's interesting because I buy consistently. I'm actually in an escrow right now in the college area, but I buy throughout several different neighborhoods. I think we have to understand your investment parameters. Some people are investing for yield, some are investing for capital preservation. So we have to understand what your goals are. Just what percent correction do you feel we're so Raphael is asking me about the crystal ball. What percent correction do you feel we're in over the next 18 months? I don't know, Raphael, and let me make sure I declare that. I do believe that we're not there. I do believe that we're not there. I'm going to call it at least 6 months away from finding a market bottom. But that doesn't mean that as a home buyer, you can't have a better deal now than then, because you also have to think about, well, what are sellers going through? What is, it's both sides. There's always a way to play the game, especially when you understand the financing side. And why are you moving? Why are you buying? Is it just pure investment? Is it for cash flow? I'm in a cash flow deal now. Is my cash flow going to be the best that it's going to be someday? No. So why am I buying? Well, I'm buying because literally I'm in an escrow, a purchase escrow, on a hold. Well, I'm buying because I'm going to marry that property. I'm going to date my rate. I'm going to have okay yield right now, but it's real estate that I absolutely want to own for the long term, and I'll refinance into a better rate later. So as far as timing, that takes a bigger picture view. But I do, like, my crystal ball, it tells me right now is I think we're 6-ish months at least out from really understanding where that bottom is going to be. Is there a difference between a depreciation market and a stabilizing market? I think so, but Badi, I need to ask you more around it. I need you to restate that question somehow. But I think what you're asking is there a difference between a market that's like dropping, depreciating versus one that's stabilizing? I think to some degree, all markets are always stabilizing. So I think that's semantics and almost just language that agenda-driven salespeople will use, trying to, help make you believe what they want to believe. And that's what we do here is like, number one, I'm going to fight for doing nothing but the truth, period. And you see like what realtor comes on and says, hey, I think we're 6 months from a bot, right? So this is a no agenda zone right here, Bobby. And I was one more question. People will when forced to, right, like losing a job, why would anyone want to sell now? Can't replace job growth in San Diego is still really good, especially. So why would somebody want to sell right now? Well, Raphael, for so many different reasons. People don't fit in their home. They all of a sudden have too many kids or too few kids. Their kids are out. Their knees are bad. Their knees are good, right? So they need a 1-story, a 2-story. They're relocated. They get a big raise, a big promotion. They sell their business. There's so many reasons why. And so there's always activity in the real estate market. It's just a fact, right? I mean, go back to the worst of days, 2008, 2009, 2010, tens of thousands of transactions were done on a yearly basis in those years. So you'll still see a moving real estate market, no question about it. And what are the tax consequences for the seller when offering a rate buy down? So when the seller offers a rate buy down, I don't want to talk from a tax perspective. Please talk to your tax, your CPA, et cetera. But that would be a cost of, that would be basically like I believe that would be treated like a closing cost. Okay, so essentially it comes out of the net proceeds of the seller. Kind of like if they gave a credit, but instead of giving a credit, which that money is used now, the beauty of the rate buy down is that money goes into that account, pays down the payments over those 2 years. And by the way, let's say that after year 1, the buyer says, hey, I found my refi. I'm refinancing out of this right now. They still have the balance in that account, and they can then take it and use it to pay closing costs on the refi. So it's a really nice strategy. It really, really works well, and it works especially well depending on your loan type. So guys, that's what we have for today. Thank you for tuning in. This is our October edition of the market update. Make sure you share this with your friends. You'll get the replay via email. And if there are any other just unfiltered, questions that you need answered, if you need someone that's going to fight for you, that's going to make your real estate world easy for you, and that's going to get you to that dream outcome with as little effort and sacrifice as possible and as predictably as possible, I'm DMB with the Beer Home team and look forward to serving you. Thanks so much. Have a great one.